Some hedge fund managers rake in over $1 billion a year, managing sums that surpass the economies of small countries, often in the headlines, sometimes for impressive returns, but other times for shady dealings, insider trading, market manipulation, Ponzi schemes, even links to notorious figures. Hedge funds are financial powerhouses. They control trillions of dollars, influence stock prices with a single trade, and help shape the global economy. So, what exactly is a hedge fund? How does it work? How do people get jobs at one? And how do they stay profitable, even when they're wrong? Let's break it down. What is a hedge fund? At its core, a hedge fund is a pool of money collected from wealthy individuals and large institutions, invested in nearly anything with the potential for high returns. Hedge funds are expected to win regardless of what the market is doing. When stocks are climbing, they're expected to beat the rally. When markets crash, they're supposed to have seen it coming and set themselves up to be profitable. There's even an unwritten rule: never lose money. Hedge funds aren't open to just anyone. You need to be an accredited investor, usually meaning a net worth of over $1 million or a yearly income above $200K. These funds don't cater to everyday folks. They operate in a more relaxed legal environment than mutual funds. They're not required to disclose every trade in real time, and they only submit quarterly reports called 13Fs. That makes them more private and mysterious. Hedge funds can use financial tools most funds avoid: short selling, leverage, and derivatives, to squeeze out those juicy gains. Short selling is betting against a stock. You borrow it, sell it now, and hope to buy it back later at a lower price. Leverage is using borrowed money to amplify the size and potential return of a trade. It can boost profits, but it can also boost your losses. Derivatives are financial instruments tied to other assets like stocks, currencies, or commodities. Think futures, options, and swaps. How hedge funds make money, even when they don't. They employ the 2 and 20 fee model. 2% of the total money they manage, no matter how well they perform, and 20% of any profits. For example, Citadel manages around $65 billion. That 2% management fee alone brings in $1.3 billion annually. One of the earliest and most common approaches hedge funds have employed is to buy undervalued companies and simultaneously short overvalued ones. The idea is to profit from the difference regardless of whether the overall market goes up or down. Global macro. These funds bet on global trends: inflation, interest rates, politics, and even war. One of the most famous trades ever was by George Soros. In the early 90s, his fund shorted the British pound, betting it would collapse. And it did. He made $1 billion in one trade. Quant funds. These rely on data, algorithms, and machine learning to make ultra-fast trades. Take Jim Simons, for example, a math genius and former code breaker. He launched Renaissance Technologies and created the Medallion Fund, which averaged 66% returns annually. If you put $1,000 into the Medallion Fund when it started, you would have $140 million. Event-driven trades. These funds bet on things like corporate mergers, lawsuits, earnings announcements, and takeovers. When Elon Musk announced plans to buy Twitter, hedge funds lined up on both sides, some betting it would fall through, others betting it would close. The ones that guessed right made millions. Of course, these are just a few strategies. Let's look at some of the biggest names in the game. Ken Griffin, Citadel. He started trading as a college student at Harvard and used a satellite dish outside his dorm room to track live prices. With $250,000 from friends and family, he built one of the most successful hedge funds ever. Citadel now manages over $65 billion. In 2022, while most markets were tanking, Citadel made $16 billion. The biggest one-year gain in hedge fund history. Ray Dalio, Bridgewater Associates, founder of the world's largest hedge fund, managing over $125 billion. He created the all-weather portfolio, meant to perform well in any economic climate. Dalio also championed a radical culture of openness and honesty at Bridgewater. Every meeting recorded. Every employee encouraged to challenge their boss. Steve Cohen, SAC Capital, which then became Point72. His firm, SAC Capital, made billions in the 90s and 2000s, until it was shut down for insider trading. Cohen paid massive fines, rebranded, and launched Point72, which now manages $30 billion. Oh, and he bought the New York Mets. Because why wouldn't he? Bill Ackman, the only cool, besides Jim Simons, hedge fund manager on the planet. He runs Pershing Square. It's an activist fund. He doesn't just invest. He pushes companies to change. His most famous fight? $1 billion short against Herbalife, which he publicly called a pyramid scheme. The legend himself, Carl Icahn, bet against him and won, while Ackman lost hundreds of millions. But Ackman bounced back. In 2020, he turned 27 million into 2.6 billion, predicting the COVID crash. Other legends include Jim Simons and George Soros, even though they've already been mentioned. Stanley Druckenmiller, he helped Soros break the Bank of England. And Paul Singer, who once seized an entire naval ship from Argentina over unpaid debt. Yes, the country of Argentina. That whole country. Now let's talk about when things go wrong. Not all hedge funds succeed. Some fail so badly, they almost take down the global economy with them. Case in point, long-term capital management, LTCM in the 90s, funded by top Wall Street traders and Nobel Prize winning economists. They believed their models were flawless. They used enormous leverage, 30-1, to make tiny but safe profits. Then, in 1998, Russia defaulted on its debt, something their models didn't account for. LTCM began losing billions fast. Because they were so deeply tied to big banks, their collapse threatened the entire financial system. The Federal Reserve had to step in and organize a $3.6 billion bailout. It was a massive wake-up call. Even geniuses, perfect models, can blow up. So you want to work at a hedge fund. Let's be real, it is not easy. First, you will likely need to attend a top-tier university, Ivy League or similar. Then you'll either study finance, economics, or take a more technical route, math, statistics, computer science, or physics. Hedge funds rarely hire straight out of college. Most recruits cut their teeth at investment banks like Goldman Sachs or Morgan Stanley, spending a few years in investment banking or trading before making the jump. Path is known as the Wall Street pipeline. There are two major roles at hedge funds: the investor/analyst, researching companies and making big bets, and the quant or engineer, who builds models and algorithms that do the trading. For investors, it's about mastering company valuation, financial modeling, and having the guts to make high conviction bets. For quants, it's deep math skills and coding ability, plus a proven system that actually makes money. And don't expect to find these jobs on LinkedIn. Most hires come through personal connections and referrals. Some firms only hire through internal networks. Hedge fund interviews are notoriously tough. Expect questions like, I give you $100 million. What's your first trade? A stock drops 30% overnight. What do you do? Two companies in the same sector. One has a PE of 10. The other has a PE of 20. Which one do you pick? Spoiler alert, there's not enough information there to make the decision. Quant interviews might sound more like brain teasers. You have a coin that flips. Would you bet on it? 51% of the time, it's tails. 49% of the time, it's heads. What do you do? A stock goes up with a 50% chance, stays flat with a 30%, and drops 40 with a 20% chance. Do you invest? They're testing your ability to evaluate risk, think fast, and show clear logic. Because in the end, all they care about is one thing. Can you make them money?